Because there are so many different types of strategies that have been labeled smart beta, it's important to ask a few simple questions when evaluating these different strategies. The first question investors and their financial advisor should ask is, what's the objective of this strategy? It's tough to evaluate whether or not you've been successful without knowing what you're trying to achieve. And so for some smart beta ETFs, that may be to maximize dividend income. For others, it may be to lower volatility. For First Trust's AlphaDex family of ETFs, it's to achieve better risk-adjusted returns in the marketplace. Once you've evaluated what your objective is, the second question we think you should ask is, what's the universe of securities that you're selecting from? For example, are they large cap stocks? Are they small cap stocks? At First Trust, we have a variety of different universes that we apply our AlphaDex methodology to. And the reason we do it that way is because in our large cap core universe, we don't want to try to achieve better risk-adjusted returns by reaching outside of that universe and buying a small cap stock, for example. The third question, once you've established that universe, is how are you selecting stocks from that universe? At First Trust, with our AlphaDex methodology, we select stocks based on a series of fundamental factors that we believe result in better risk-adjusted returns. So for example, we select value stocks based on price-to-book ratios, price-to-cash flow, as well as return on assets. For growth stocks, we screen them based on momentum over 3 time periods, 3, 6, and 12 months. We rank them based on price-to-sales ratio, so there's a valuation factor, and we rank them based on 1-year sales growth. And that's how we select stocks for our AlphaDex strategies, but different smart beta strategies select stocks differently. Once you've selected your portfolio, the next question to ask is how are those stocks then weighted in the portfolio? Some smart beta strategies will equal weight the fund. Others will do some sort of a market cap adjusted weighting for the portfolio. Our AlphaDex strategies weight the portfolios on the basis of the score that they receive in the model. The reason we weight the portfolio in that manner is that we want to overweight stocks that have attributes that we believe will result in better risk-adjusted returns over time. We overweight those that have a better ranking and underweight or eliminate stocks that have a worse ranking. The next question you should ask once you've selected and weighted your portfolio is, how frequently is this process applied? For a market cap weighted index, that's a less important question to ask because the market determines the weighting in the portfolio. If a stock gets more valuable, it becomes a larger market cap and becomes a larger part of that index. But for smart beta, it's different. Our strategy with AlphaDex is applied on a quarterly basis for domestic strategies and a semi-annual basis for international strategies. And the reason we do that is because we want to have a strategy that's always seeking value on the value side and always seeking reasonably priced momentum stocks on the growth side. So that's the last question we think investors should ask as they're evaluating smart beta strategies. One key takeaway that smart beta investors should know is that all smart beta ETFs and all smart beta strategies are created in different ways. They're different strategies with different objectives and different ways of achieving those objectives. So it's really incumbent upon an investor in consultation with their financial advisor to determine how they best fit in a portfolio. All strategies are not alike, and therefore it makes sense to look at the underlying strategy and see how it fits.